Welcome back to Talk Tickers. This is the show where we strip the fluff from the earnings call and get straight to the alpha.
Right, we just ignore the corporate PR spin.
Exactly. If you're listening to this deep dive, you care about where the capital's actually flowing.
You want the mechanics, not the marketing.
Right. And today we have a really interesting one. We are dissecting a company that is arguably the most important industrial concern you might not be watching closely enough.
Definitely not watching closely enough.
We are talking about BWXT Technologies. Ticker is BW-XT.
The nuclear darling. Or maybe the nuclear paradox today.
Yeah, paradox is a good word for it. It is Monday, February 23rd, 2026. The market has just closed. The after-hours tape is running.
And it is red.
It is very red. We have a confusing situation on our hands. We are looking at a company that management claims is sitting at the, quote, intersection of national security and commercial nuclear power.
Which is a very expensive, very high-stakes intersection to be parked at right now.
It really is. But here is the setup for you listening at home. They just posted a double beat, top line and bottom line.
Crushed it.
They posted a massive, and I mean massive, backlog expansion.
Yeah.
And they basically reaffirmed that the nuclear renaissance is not just a concept anymore.
Right, it's an operational reality.
And yet,
the stock puked.
It took a massive dive. Despite a quality beat, it was down about 3.9% in the regular session leading into the print.
Yep.
And then it kept sliding, down another 0.7% in the after hours.
It's just a classic valuation wall.
A valuation wall, right. So we are going to spend this deep dive explaining why the market sold the news on what looks, at least on paper, like a pristine quarter.
Because you can have the best engine in the world, right?
Yeah.
But if you drive it into a brick wall of expectations, you're going to get a dent.
That is exactly what happened here.
Right.
So here is our roadmap for today. We are going to hit the headline numbers first, just so you know the score.
Got to know the baseline.
Right. Then we are going to tear apart the government versus commercial split, because there is a very serious divergence happening under the hood there.
Massive divergence.
We also need to analyze the financing, which I think you called a masterstroke in our pre-show notes.
I stand by that. It is financial engineering at its absolute finest.
We will get into that. And then we're going to finish with a trade idea in our not financial advice segment, betting on what looks like some heavily sandbagged guidance.
Oh, they are definitely sandbagging.
But let's start with the scoreboard. What actually happened today?
Okay, so let's look at the tape. Adjusted EPS came in at $1.08.
Okay.
The consensus on the street was 91 cents. So that is a 17-cent beat.
17 cents.
Right. And in the world of industrial defense contractors, that is a massive beat.
I mean, that's not a rounding error. That is a significant deviation from the model.
No, it's huge. And then revenue clocked in at $885.84 million against a consensus of roughly $837 million.
So another beat there.
Exactly. You are looking at nearly 19% year-over-year growth, which, if you just looked at those two numbers, revenue up 19%, earnings crushing the estimate.
You would think the stock would be up 5 or 10%.
You'd think it'd be flying. But it's not just about what they did yesterday, it's about what they are going to do tomorrow.
Which brings us to the wow metric of the night, the backlog.
This is the star of the show. If you take nothing else away from this earnings call, look at the backlog.
It hit $7.3 billion.
$7.3 billion. That is up 50% year over year.
Let's just pause on that for a second. A 50% jump in backlog for a mature, heavy industrial company.
It's totally unheard of. I mean, usually in this sector, you think of Lockheed, you think of Northrop, General Dynamics. You are fighting tooth and nail for like 5 or 8% book-to-bill growth.
Like you're just trying to outpace inflation.
Exactly. You're happy if you keep pace with inflation and maybe add a submarine contract here or an aerospace component there. A 50% step change means visibility has fundamentally shifted.
This isn't just a pipeline of hopes and dreams.
No, this is ink dry on the paper, binding contracts.
So effectively, they have secured the revenue for the next 2 to 3 years.
Guaranteed. It de-risks the future entirely. When you have a backlog that large relative to your annual revenue, you stop worrying about where the next meal is coming from.
You just worry about how fast you can cook.
That's exactly it. It's all about operational execution now.
So we have a monster beat. We have a massive backlog. Let's just quickly frame the full year 2025 recap to set the baseline for the listeners.
Sure. Full year revenue landed at $3.2 billion. That's up 18%.
Okay.
And adjusted EBITDA came in at $574 million, up 15%. So they are scaling profitably.
They are. And the guidance for 2026, which is really what the algos were trading on post-market.
Also ahead of the street, they guided revenue to about $3.75 billion. The street was sitting at 3.67.
So a top-line race.
Right. And they guided non-GAAP EPS to a range of 4.55 to 4.70. The street was at 4.30.
Okay, let me get this straight. Beat on earnings.
Yep.
Beat on revenue, massive backlog expansion, guidance raise above consensus.
Across the board.
And the stock is down.
Welcome to Priced for Perfection. You have to remember where we came from.
The chart has been a rocket ship.
Exactly. BWXT hit an all-time high of around 220 back in January. The implied volatility going into this print was absolutely sky high.
The options market was pricing in a violent swing.
We're talking 96th percentile IV. Everyone and their cousin knew the backlog was going to be good.
Because the smart money tracks the naval awards.
Exactly. The naval awards are public record if you know where to look in the DoD budget. Plus, everyone knew about the Connectrix acquisition.
So it was a crowded trade.
Unbelievably crowded. This is a textbook sell the news event, a liquidity flush.
The tourists got excited by the headlines.
But the pros looked at the valuation multiple and said, okay, you beat. But you didn't give us the miracle we needed to justify a 40x multiple.
So they hit the bid.
They took profits and walked away. It's an unwind.
It really feels like the market is punishing them for being too good, too predictably.
Or perhaps punishing them for a lack of a specific catalyst, which we will definitely get to later when we talk about the medical isotopes.
Right. But let's peel back the layers of the actual business. Because the divergence between their two main segments, government and commercial, is where the real story is hiding.
That's the meat of the deep dive.
So let's start with the government moat. This is their bread and butter, naval propulsion. Building the reactors for the submarines and the aircraft carriers.
The foundational revenue.
But looking at Q4, government operations revenue was actually down 1%.
Right. And that is the headline that probably spooked the algos initially. Because why is your core monopolistic business shrinking?
But if you listen to the commentary from Rex and Mike on the call, it's purely timing.
It is.
So unpack that for us. What kind of timing? Because usually when his company says timing, it's an excuse for losing a contract.
In this case, it's legitimate accounting physics. Earlier in the year, Q1 through Q3, they had a huge boost from long-lead material procurement.
Explain long-lead material.
Basically, the Navy pays them to buy the raw stuff. The exotic alloys, the heavy forged steel, the specialized components that they need to actually build the reactors years from now.
Because you can't just buy nuclear-grade steel at Home Depot.
Exactly. It takes years to forge. So the spending for that happened early in the year, and it tapered off in Q4.
So they bought all the groceries in Q1, and now they're just cooking in Q4.
That's a perfect analogy. The revenue recognition on procurement is very lumpy. Also, they had lower microreactor volumes in the quarter compared to the previous year.
So it's lumpiness. It's not demand destruction.
Not at all. It's just the rhythm of government contracting. It ebbs and flows quarter to quarter.
But the margins also took a hit in government. EBITDA margins dipped to 18.8%.
Down from a full-year average of over 20%.
The compression. Are labor costs eating them alive?
No, this is critical to understand. It's the mix shift. They're ramming up entirely new programs, specifically defense fuels and the HPDU program.
The military loves its acronyms. What is HPDU?
High purity depleted uranium. When you start a massive new government program like that, you have to build the infrastructure first. You have to stand up the factory lines.
You have to train the technicians.
You have to buy the tooling. That costs money up front. And you have to recognize those costs before you hit the efficiency milestones where the profit margin actually expands.
So they are investing in growth, and the P&L takes a temporary hit for it. Exactly. It's a classic J-curve. You spend money to make money later. And management was very clear on the call. This isn't a permanent impairment to their margins.
They expect margins to rebound.
They expect them to start expanding again in 2027. But for 2026, we are going to see some pressure there as they build out these new lines.
Got it. But the naval anchor itself, the submarines and carriers, that is stable.
Rock solid. They have the pricing agreements locked in. And there was a quote that really stood out to me from the CEO.
What was it?
He said shipyard throughput is finally bouncing off the bottom.
That is huge news for the supply chain. Because for the last 2 years, all we've heard is that the shipyards cannot hire enough welders. Correct. The shipyards, places like Electric Boat and Huntington Ingalls, they have been the primary bottleneck.
If they can't build the hull of the submarine, they can't take delivery of the reactor.
Precisely. The reactor just sits there waiting. So if the shipyards are finally speeding up, that pulls demand forward for BWXT. They have visibility through 2027 and well beyond on the naval side.
That is the stability you pay a premium for. Now let's talk about the alpha projects in the government sector, the stuff that sounds like straight up science fiction.
The fun stuff.
Project Pele.
Right, Project Pele. This is the transportable nuclear microreactor for the Department of Defense. They just delivered the first core of TRISO fuel to the Idaho National Lab.
TRISO fuel. Let's explain this to the listener. This is the tennis ball size fuel that physically cannot melt down, right?
Essentially, yes. Though it's actually poppy seed-sized particles of uranium packed inside a billiard ball-sized sphere of graphite. But the concept is exactly what you said.
Each particle is wrapped in ceramic.
Right. It creates its own microscopic containment vessel. It is extremely robust. You can heat it to insane temperatures and it won't crack. Delivering the core to Idaho National Lab is a massive milestone.
It means the hardware is real. It's not just a PowerPoint deck anymore.
Exactly. It's tangible progress. And then you have the uranium enrichment side of the house, which feels intensely geopolitically significant right now.
It really is. The source material notes, they stood up a centrifuge manufacturing facility in just 7 months.
7 months?
That is mind-blowing.
Yeah.
7 months to build high-tech centrifuges for uranium enrichment.
It's unheard of in the nuclear industry. Usually, regulatory approvals alone take years.
Yeah.
But this is critical because the U.S. has a massive shortage of domestic enrichment capacity.
Especially for HLEU. Right. High-assay, low-enriched uranium.
Exactly, the fuel of the future for all these advanced reactors. And we used to buy a huge chunk of our enriched uranium from Russia.
And now, obviously, we can't.
Right. It's a national security imperative to break that dependency. Just to be clear, we are neutrally reporting management's strategy here, but the geopolitical reality is driving the funding.
BWXT is positioning itself to be the domestic supplier.
They are building the critical infrastructure, and that's why the government is throwing money at them. But again, these are early-stage ramps.
So they drag margins down today to create a monopoly tomorrow.
Exactly. You are paying for the moat.
And space. They mentioned NASA on the call.
Nuclear thermal propulsion.
Yeah.
They are still actively working on the engines that will eventually take us to Mars.
Wild.
And they are eyeing fission surface power for lunar bases. It's a small revenue contributor right now, but the optionality for the 2030s is immense.
Okay, so the government segment is this stable, slightly lumpy giant that is heavily investing for the future. Now let's look at the rocket ship, the commercial segment.
This is where the aggressive growth is happening. Commercial operations revenue was up 95%.
95%. I literally had to double check that number when I read the release. Almost doubling year over year.
It is staggering. Now, we have to be honest here, a large chunk of that is inorganic. It came from the Connectrix acquisition and AOT.
Right, so they bought revenue.
They did. But even if you strip all of that out, organic growth was still 31%.
31% organic growth in a heavy industrial sector is still wild. That is a growth rate usually reserved for software as a service companies.
It's hyper growth. And unlike the government side, the margins here are actually expanding.
Expanding while growing top line that fast.
Yes. EBITDA margins improved to 14.9%, and management is guiding for another 100 basis points of margin expansion in 2026.
Let's break down what is driving that commercial rocket ship. Medical is a big piece.
Huge piece. The medical business crossed the $100 million annual revenue mark, and it's growing at roughly 20%.
This is their isotope business.
Right. They are selling things like strontium-82 and germanium-68. These are used for diagnostics and therapeutics in hospitals globally.
But the elephant in the room, or I should say the elephant not in the room, is Tech-99.
Technetium-99 meter, the absolute workhorse of medical imaging. It is used in tens of millions of heart stress tests and bone scans every single year.
And BWXT has been trying to bring a proprietary generator for it to market for years.
And it is still not there.
It's stuck.
It is stuck in what the CEO called the grueling last mile. They are dealing with FDA quality infiltration work.
Because it's hard science.
Exactly. You are injecting this radioactive material into people's veins. The purity standards are insanely strict. And here is the kicker for the valuation, and probably why the stock sold off.
Let me guess. It's none of the guidance.
Tech-99 is not in the 2026 right. So if it happens, the stock re-rates immediately. It's hidden value.
Okay, let's move over to the international play within the commercial segment. They announced something about Bulgaria.
The Kozloduy AP1000 reactors.
Right. BWXT won the owner's engineer role. That sounds like a consulting gig. What does owner's engineer actually mean?
It does start as consulting. You help the country design the project. You help them manage the regulations and the site prep. But think about the strategic nuance here.
It's a Trojan horse.
Exactly. If you're the owner's engineer, you are the one writing the technical specs for the reactor build. You are helping them decide what exact parts to buy.
And who happens to sell the heaviest, most complex nuclear components in the world?
BWXT does. It positions them beautifully to bid on the massive steam generators and the pressure vessels later down the line.
It's a foot in the door that eventually opens the whole house.
Exactly. It is very strategic positioning.
And this ties perfectly into their strategy with SMRs, right? Small modular reactors.
Yeah.
Because they aren't betting on one specific horse.
No, and that is the smartest play they could make. There are a dozen SMR designs out there competing for dominance right now. You've got GE, Hitachi, NuScale, Westinghouse, Rolls-Royce.
It's a crowded field.
It is. BWXT isn't trying to pick the winner of the design race. They want to be what they call the super merchant supplier.
They just want to build a heavy iron for all of it.
Exactly. The pressure vessels, the heat exchangers, they don't care who finds the gold in the SMR rush.
They are just selling the shovels and the pickaxes.
They want to outfit every miner in the valley. If an SMR gets built, they want a piece of the manufacturing margin.
I love that business model. Okay, let's shift gears to segment 3, the financial engineering masterclass. You were raving about this in our prep session.
I really was. I mean, in a high interest rate environment, even as rates have stabilized somewhat, capital is still not cheap. BWXT pulled off an absolute magic trick.
They executed a $1.25 billion convertible debt offering.
With a 0% coupon.
0% interest. Literally free money. How do you get free money in this macro economy?
You offer the lenders the option to convert that debt into stock if the price goes high enough.
Right.
Investors are so hungry for pure play nuclear exposure right now that they were willing to lend BWXT $1.25 billion for free just for the chance to own the stock later.
But hold on, let's explain the mechanics to the listener. Doesn't that dilute the existing shareholders? If the stock goes up, you have to issue millions of new shares to pay off those bondholders.
And that is where the masterclass part comes in. They bought a capped call hedge.
Walk us through a capped call.
Effectively, they used a small portion of the cash they raised to buy options that offset the dilution. The effective conversion price for the debt is now pushed up to over $396 per share.
396, and the stock is sitting at around 200 today.
Exactly. So unless the stock basically doubles from here, there is absolutely zero dilution to the current shareholders.
That is brilliant.
They basically secured $1.25 billion of interest-free capital. They used it to pay down their existing floating rate bank debt.
Which instantly lowers their interest expense.
Right. It boosts their bottom line. It boosts their liquidity to $1.7 billion. And it creates an incredible war chest.
A war chest for what, though?
M&A or massive capital expenditures. When you have $1.7 billion in liquidity, you can buy a specialized manufacturer to vertically integrate, or you can drastically expand a factory.
It gives them immense strategic flexibility without the fear of immediate dilution.
Exactly. And speaking of expanding factories, let's talk about CapEx. They are guiding capital expenditures to rise to about 6% of sales in 2026.
To support all this growth.
Right. And they mentioned a very specific location on the call, Mount Vernon, Indiana.
This is a sleeper detail that I think the generalist analyst completely missed. Mount Vernon is a heavy manufacturing facility. It sits right on the Ohio River.
Why does the river matter so much?
Physics. An SMR reactor vessel is massive. It weighs hundreds and hundreds of tons. You physically cannot put it on an 18-wheeler truck.
It would crush the highway.
Right. And you cannot put it on a standard train. It's too wide, it's too heavy. The only way to move it from the factory to the actual power plant site is by barge on the water.
So if you want to be a serious player in the SMR market, you have to have a logistics moat. You need water access.
Exactly. And BWXT's M. Vernon site has a 1,000 metric ton crane capacity right on a barge slip.
That is irreplaceable infrastructure.
And they are actively considering a major facility expansion there specifically to support the commercial nuclear market.
So if they pull the trigger on that Mount Vernon expansion, it is a massive signal that the SMR orders are real.
It's the ultimate tell. You don't build a billion-dollar factory extension for a maybe. If they announce it, it means the order book is full.
We are definitely coming back to that in the trade pitch. But let's move to segment 4, operational edge. There were some really interesting nuggets in the Q&A about their internal technology.
Yeah, the AI implementation. Usually when a CEO starts talking about AI at a heavy industrial earnings call, I just roll my eyes.
Oh, it's usually just buzzwords to try and pump the valuation multiple.
Exactly. We are using AI to optimize our email routing. Who cares?
But Rex, the CEO, actually gave a highly concrete example. Phase 1 of their AI rollout is machine learning on weld inspections.
Tell me more about that. How does that work?
They're using hyperspectral sensors to watch the welding torches in real time on the factory floor. The AI analyzes the light spectrum of the weld as the metal is melting.
Wow.
So if the temperature or the alloy composition drifts even slightly out of spec, the AI flags it immediately.
So you stop the bad weld before it's even finished.
Exactly. Instead of finishing the massive component, putting it in an X-ray machine 3 weeks later, realizing there is a microscopic void, and having to grind it all out and redo it.
That saves millions in rework costs and months of schedule delays.
That is real, tangible margin expansion driven by AI, not just a buzzword.
That's incredibly impressive. And they are doing this in classified environments.
They are, which is logistically tricky because you generally cannot have Wi-Fi or Bluetooth devices in a secure DoD facility.
Right, security risks.
So they are working closely around those air gap restrictions with the customers. But phase 2 is using LLMs for internal data efficiency, like customized ChatGPT instances for their engineering docs.
And phase 3?
Phase 3 is full digital twins of the entire factory, simulating production runs before they cut a single piece of steel.
They are really dragging this industry into the 21st century. Let's briefly touch on the macro stuff.
Yeah.
Tariffs and trade wars, everyone is worried about that right now.
Zero impact so far. They operate largely under the USMCA, the old NAFTA agreement.
U.S., Mexico, Canada.
Right. And even with all the political noise happening right now, their supply chains for medical isotopes and nuclear components are currently shielded.
Because they are critical infrastructure.
Exactly. And to reiterate our stance, we aren't taking sides on trade policy, just reporting the facts of the call. But no politician wants to be the person who slaps a tariff on cancer treatment isotopes.
Fair point. Now, before we get to the trade idea, I want to talk about the sandbag. You mentioned this right at the beginning. The guidance for 2026.
Yes. Management explicitly stated that their results this year will be heavily back half weighted.
Meaning the profits come later in the year.
Right. They said 55% of the EBITDA will come in the second half of 2026.
And Q1.
Q1 is expected to be basically flat year over year.
Flat. After printing 19% growth in Q4.
Yes. That creates a very low bar for the start of the year.
It really lowers expectations for the next print.
But it also sets up a brilliant scenario for them. If they execute just a little bit better than expected in Q1 or Q2, they will be beating and raising their guidance all year long.
It's a classic management game. Guide low early, beat high late.
Exactly. But it requires flawless execution in Q3 and Q4 to make the full year numbers work.
Okay, let's zoom out and look at the broader investor context. The stock is down today. The bears are growling. Why?
The bear case is simple. It all comes down to valuation. The stock was sitting at $220. That is a very rich multiple for a defense contractor.
To sustain that, you need absolute perfection.
You need a beat, you need a raise, and you need a miracle catalyst on top. They got the beat and raise, but they didn't get the miracle.
They wanted a firm Tech 99 launch date.
They wanted Tech 99 revenue modeled in, and they wanted explosive margin expansion in the government segment immediately.
They didn't get either, so the momentum traders bailed.
The smart money knew the backlog jump of 50% was coming. It was priced in, so they sold the news.
And what is the bull rebuttal to that?
The bull rebuttal is that the backlog is real. $7.3 billion in binding contracts is not fluff. Commercial nuclear is compounding at 20 to 30%.
And the balance sheet is a fortress with that 0% debt.
Exactly. Plus, any regulatory win on Tech 99 or any new SMR hardware orders like those AP1000 steam generators is immediate unmodeled upside.
The bad news is priced in now. The froth has been blown off the top.
That's the thesis. The tourists are gone, and the long-term holders can start accumulating at a more reasonable multiple.
Which brings us to our favorite part of the show.
My lawyers are sweating already.
They always are. This is the segment where we pitch a trade idea based on the deep dive. But we have to say it loudly and clearly.
This is not financial advice.
We are a podcast. We are just two voices in your headphones. You must do your own diligence. Do not trade based on what we say. We are just exploring potential scenarios based on the data.
We are role-playing. Imagine we are sitting in front of the investment committee at a multi-manager hedge fund today.
Okay, analyst, the floor is yours. What is the pitch?
I call this trade the Ment-Burn and Straddle combined with the isotope ARB.
Catchy name. Walk us through the thesis.
The thesis is this. The market is currently punishing BWXT for a lack of clarity on Tech 99 and the temporary lumpy margin compression in government.
The stock dropped, so implied volatility is crashing.
Right. Forvy is crushing post-earnings, which means options are getting cheaper. But that 0% convertible debt means they are hunting for something big, M&A or massive capex.
You think a major announcement is imminent?
I think news is inevitable in the next 12 to 18 months. So here's the trade structure. First leg. You go long on January 2027 calls. Out of the money.
Like the 230 or 240 strike.
Exactly. Why January 27? Because you need enough runway for the catalyst to actually play out.
And Catalyst 1 is the facility expansion.
Right. The Mount Vernon expansion announcement. Management hinted at it. If they officially announce a dedicated SMR heavy vessel factory, the market will finally realize they're the only domestic player who can barge ship these reactors.
It cements their monopoly. That changes the terminal value calculation for the stock entirely.
And Catalyst 2 is Tech 99. It is currently excluded from all guidance. If they solve the FDA filtration issue by Q3 of 2026, they drop a massive high-margin revenue stream onto the P&L.
A revenue stream that analysts have modeled at exactly zero.
It is an earnings surprise just waiting to detonate, so you are long those calls.
Okay, so that is the long side. What is the short side of the trade?
You sell near-dated puts or sell a put spread to define your risk.
Why are we selling puts?
You want to take advantage of the fact that the stock just dropped and volatility is still slightly elevated on the downside. You are betting that the floor is effectively in.
Because of the backlog.
Exactly. That $7.3 billion backlog puts a massive fundamental floor under the stock. It is highly unlikely to crash another 20% from here with that much guaranteed work on the books.
So you sell the downside volatility to finance the purchase of the long-term upside calls.
Yes. You are financing your lottery ticket with the premiums you collect from the panicking bears today.
It's an asymmetric bet on execution and logistics dominance. You're fading the post-earnings drop to bet on two specific hidden catalysts that management teased but didn't promise.
It is aggressive, but it has rigorous logic behind it. It is really the only way to play a stock that is priced for perfection after it takes a dip.
I like it. A very clean setup. All right, let's wrap this up. Give us a quick recap for the listeners driving home.
Top line, BWXT delivered the numbers. They beat on the top, they beat on the bottom. The backlog is an absolute monster at $7.3 billion.
The market just sold it because the valuation was too rich and the shiny object of Tech 99 got delayed.
Exactly. But fundamentally, this is the company building the literal engines of the nuclear renaissance, from submarines to small modular reactors to lunar bases.
If you believe in the future of nuclear power, you have to look at BWXT.
You really do. The price drop today just fleshes out the weak hands and the tourists.
I'll leave you with this final provocative thought. Don't just watch the headlines next quarter. Keep a very close eye on their backlog conversion rate. How fast are they turning that $7.3 billion into recognized revenue?
And keep your eyes on the Mount Vernon crane.
Yes. If you see satellite imagery of that 1,000-ton crane moving heavy steel onto a barge in the Ohio River, the stock is going to start moving with it.
Absolutely.
That is it for this deep dive into BWXT Technologies. We will see you all next time. Over and out.